Welcome to Talk Tickers. Now, Oklo's latest earnings call might seem like a simple story of a miss on the bottom line, but if you look a little closer, there's a major strategic pivot happening that could completely, and I mean completely, change the game for this company. So let's break it all down. Okay, let's dive right in. So on the surface, the numbers look, well, not great. Oklo reported a wider than expected loss, with a GAAP EPS of -20 cents. That missed the consensus estimate by a full 7 cents. And of course, they're a pre-revenue company, so the top line came in at 0, which is exactly what everyone anticipated. No surprises there. So how did the market react? Well, the immediate reaction was a slight pullback. The stock traded down about 2% in the after-hours session. It definitely signals some investor caution on that EPS miss. But look, it's certainly not a panic, just a little tap on the brakes. But honestly, the numbers don't even begin to tell the real story here. The most significant update from this call, the thing you really need to pay attention to, was a major strategic pivot in their regulatory approach for their first Aurora powerhouse out at Idaho National Laboratory. This is where it gets really interesting. Okay, so this slide really shows you the key difference. The old NRC path was just slow and sequential. You had to get all your approvals before you could even think about pouring concrete. But this new Department of Energy pathway, it lets Oklo build the plant while the licensing review is happening in parallel. It is a massive, massive accelerator for their timeline from design to operation. And you don't just have to take my word for it. CEO Jake DeWitt put it perfectly. He framed this as a huge de-risking event for the company. It allows them to stop waiting around and move directly into build mode way, way faster. It's a fundamental shift from just doing paperwork to actually making physical progress. All right, let's move on to the next crucial piece of this whole puzzle, the fuel. You can have the fastest regulatory path in the world, but without fuel, you've got nothing. Management spent a ton of time on the call outlining a multi-pronged strategy designed to make sure they have a secure, resilient supply for their reactors. And they've broken this incredibly complex problem down into 3 pretty clear stages. So in the near term, they're going to use government-supplied bridge fuels. For the midterm, they're busy securing commercial HALEU, that's high assay, low enriched uranium, which is absolutely crucial for these advanced reactors, and they're doing that through key partnerships. And then for the long term, they're aiming for total independence with their very own domestic recycling facility. So the crucial point here, the real kicker, is the government making this plutonium available as a bridge fuel. I mean, this is a massive supply that, as management pointed out, could fuel their first 10 to 20 plants. That fundamentally changes the whole fuel constraint problem for the company's near-term future. It's a huge weight off their shoulders. So, with these huge, long-term strategic plays in motion for both regulation and fuel, you might expect a really strong market reaction, right? But that's not quite what we saw. And this brings us to the core tension in the stock right now. There's a real divergence between how the market is looking at things and how management is. It feels like the market is fixated on the short-term stuff you can plug into a spreadsheet, the quarterly cash burn, the pre-revenue status, that EPS miss. Meanwhile, management is pointing to these multi-year strategic wins that are much harder to model. Things like the DOE pathway, hitting construction milestones, and securing over a decade of fuel. It's a classic battle of short-term financials versus a much longer-term vision. So let's try to put it all together. What does all of this mean for the stock going forward? Let's break down our view right here in our next call segment. So what's the call on Oklo? Our take is this. We see a company that has massive, and I mean massive, long-term potential. They're making very real, very significant strategic progress. But, and it's a big but, that potential is balanced against some pretty serious near-term execution risk and a valuation that is still pricing in a lot of future success. And for that reason, we are initiating with a market perform rating. The huge regulatory de-risking from that DOE pathway is a major, major positive. But for now, it's balanced out by the pre-revenue cash burn and the absolute need for them to execute flawlessly on their construction timelines. There's just no room for error. So, looking ahead to the next quarter, here's what you need to be watching for. 2 key milestones: a finalized agreement with the DOE and visible progress, like actual dirt moving, on the excavation at the Idaho site. We expect the stock to kind of trade in a range, and it's going to be highly sensitive to any news on these catalysts. The key risk here? Any slippage in their timelines or any unexpected capital expenditure inflation. That could really pressure investor sentiment.
As always, this is our take on the latest earnings call. It is not financial advice, so please be sure to do your own research.